Okay, guys. Well, here we go. Here's the ratio. Long 1, short 3, long 2. We paid $2.53. Okay. So anything under the first long call strike is going to be maximum loss. Right? So anything down here, we're going to lose our investment of $2.53. Okay, at 133.53, that's our break even. And then you'll see we start to make money, and make more money as we get up towards the short calls, which are the 143 strike, which is our maximum value. I'm not finished there yet, Simon. That's where I realized that you guys were not listening to me because I had the mute on. Sorry. Okay, so we still are going to make money all the way up to some point, but then it's going to level off because the short 3 options are going to take over for our long 1 option. And at 149, which is the top strike, that's where our loss starts to begin. Well, not starts to begin, but that's where the maximum loss, I should say, starts to begin again. Okay, but now you'll see as we go up here, that loss is going to remain the same. And I think I may have messed up your ratio. Mark, is this all correct? Are these strikes all correct? Or did I mess? Okay, they are. Okay. I thought I had something else where it was equivalent between the $12 and then the $18. So you will see that there is upside loss, further loss potential on this ratio. And that is because, I'm going to spell it out here for you, and my apologies for my explanation later. I just clarified it with Mark. Okay, what you will see is we are long one $12 wide spread, right? Because we're long 131 and short a 143. So we're long a $12 spread. However, if we break down the other part of this, we are now short 2 $6 wide spreads. Okay, so we are actually, even though we have the proper amount of units, 3 and 3, because, what do I need to do, Simon? It's 2, Jake, because we're long 1. Remember, the ratio here is 1 to 3 to 2. So we're long 1 of these. So that removes that and makes that 2. And then we're short 2 of those. Simon, I don't understand what you mean. That's irrelevant, Fong. It's the 13th, but that's irrelevant. Simon, I'm not understanding what you're saying. And now, okay. So, guys, now I understand why I am so confused, is because my calculations are not correct here. Yes, that is correct, Simon. And why is my calculation not correct here? Look right here. And this is really good that we're going through this, guys. And I knew when I changed my normal formulas up here, that's where the problem was. J12 is 3. J12 is 3. Right, but why is that? It should be 0, Simon. Why is it not? Look at my formula up here, and why is it not? And I just recognize this. What am I missing there? What am I missing right here, guys? Yep. An additional M13, which is the 149 call. I only have 1 in the equation and not 2. So that is what is throwing me off. Because in our normal butterflies, and I use this from our template from our normal butterflies only have 1, 2, 1 as the ratio, not 1, 3, 2. So there we go. That now, phew. Man, I was going to have to go back 29 years to go back to my formal training of option trading. Now I feel better. I'm sure I freaked you out, Mark. I'm sure. I was freaking myself out, not understanding why that wasn't maxed out at a 253 loss, and I'm looking and looking and looking, and then realized that I only had 1 of the 149 calls in there. Phew. Okay, so does everybody see this? Well, you pay less, and if you hit the short strike, you have more upside. So Mickey, this kind of goes into your question that you've been asking for the last couple days. Yeah, that's basically what this is. That's basically what this is. Well, the drawback is look at the first option that Mark is using. Okay, the first option he's using was actually an in-the-money option. So this spread is going to cost more upfront to get to that 143 level, but it pays more. Okay, it's not our typical reward to risk metrics because we're not using, we are using the expected move. So 143 is the target, but Mark was using a deeper in the money call that cost more money. So if you look at his reward to risk here, okay, his reward to risk is almost 4 to 1. You know, we're typically looking at like 3 to 1. His is almost 4 to 1 because he's taking more risk because he's buying a more expensive option to start with. Right, the 131 was Mark, but we wouldn't typically buy an at-the-money call as our first option, right, or put. Our first strike would be out of the money. Cheaper, Mickey, in terms of greater reward to risk. Costs more money, greater reward to risk. But it's really important the way that Mark set this up in terms of the strikes that he used, because if he would have used other strikes or set up the ratio differently, he could have had a different risk profile so as he could have lost more money to the upside. To the downside, if all the strikes go out worthless, out of the money, you can only lose what you pay. But if he had set this up differently to the upside, that could have been the problem that he had. So Mark, you were spot on. All right, sorry for the confusion with the formulas, guys, but I was kind of driving myself batty when I saw that and then realized that we were missing one option. All right, let me post this up here. So this will be the MDB ratio call butterfly P&L example. What is today? Today's date is the 10th. You definitely can, Mickey. Let's say he had used the 135, okay? First off, the price paid would have been a lot different. Okay, he's got a 1 to 3 to 2 ratio, so the units line up. Okay, the price would have been a lot different. In fact, it probably would have been a credit for this thing. Okay, but look what would happen at the value of this spread up at 160. That would remain the same. This would go to okay, so now you could see what that would have been worth. So it all depends on the strikes that you're using. Okay. All right, let me get this posted up there, guys.